Welcome back to our intermediate financial accounting class. This is our last segment on revenue recognition, or RevRec as it's commonly called in practice. We've talked about a lot of things about revenue recognition, how it's changed, what the new steps are, what the principles are, lots of different examples. And the last thing we need to talk about is what happens if you want early revenue recognition, pre-delivery revenue, but you don't have all the numbers that you need. So we talked about one method, the percentage of completion method, where you can estimate how much you're going to get paid, and it's enough to cover your costs. And you can estimate how far along you are. And then you can show a profit every single period as you recognize that revenue and complete the work. The next method we talked about was, we know we're going to at least cover our costs, but we don't know how much we're going to get as a profit, or we're not 100% sure how far along we are. Then we still get to recognize some revenue, but it matches our costs exactly. So we recognize zero profit. The last method is what happens if I don't know how far along I am, and I'm not sure what they're going to pay me is going to be enough to cover my costs. When that happens, if I'm not sure that I'm going to cover my costs, then the rule is you have to wait till the end and recognize the revenue once the whole project is done, which is really depressing for a business because it means that they're just stuck showing no revenue for the whole length of the project. No cost of goods sold either, luckily, but no revenue. And that can really hurt a company that's looking for financing or that has other obligations and needs to show some profit. So companies avoid this if at all possible, but sometimes it happens. And here are the steps if that happens. We recognize everything into a contract asset account. We recognize anything we receive as a contract liability. And then at the end of the period, we get rid of the contract asset and contract liability accounts and show some cost of goods sold and some revenue. Basically, this process is simply allowing us to have a contract asset and a contract liability that offset each other so that at least our ratios don't get messed up too badly. And that's the only benefit of this method because it allows us to do this asset and this liability. It's exactly the same as what would happen if we didn't try to do early recognition at all. We would do this for anything that we didn't want to try to recognize early. So again, FASB actually prefers this, but most companies don't because there's no revenue as we go. Once again, we're going to use the exact same scenario to take a look at an example. We're going to assume here that the road can't be used for anything else, but they found a lumber company that needs a road in the same general area as the highway. Because of this alternative, CCC could now sell the road to either Washington State or the lumber company. Well, if you remember, the only reason that we could recognize revenue early for this example was because CCC could only sell the asset to the state. That's one of the qualifications, or one of the things that allows us to recognize revenue early, is it has a unique purpose for the buyer. And we can only sell it to that one buyer. Well, now that I've got two buyers, even though I've got good estimates, I can't use an early delivery method because I could sell the asset that I'm creating to two different groups, and they could both use it. And that's the other reason that kills this early delivery method. Sometimes it's the estimates, sometimes it's because you don't meet that early criteria. So, and the other option is I just don't want to, and that's possible too, because FASB always allows you to wait till you're done. So let's go through this exact same scenario, but this time assuming that because I could sell it to two different bodies, I can't do early recognition. All the numbers otherwise stay exactly the same. And again, I've got a handout for us to speed this up. In this case, all of the journal entries are done for us. All we have to do is keep track of our T accounts because everything else is done. So you can see here, there's our contract asset and our cash. So we've got $3.4 million that go into the contract asset. Contract liability is the $1 million the state has paid us. So we end the period with a balance in both accounts for the first time. We haven't seen a contract asset balance before because we've always gotten rid of it as cost of goods sold. But in this case, it's going to build up. As we move into year two, there's our beginning balances and our journal entries. $15.5 million goes into our contract asset. And the state pays us $14,750,000. But again, even though they're paying us, so it obviously is going to belong to them, because of that other qualification, I can't just show revenue. I have to wait until the end. I don't meet the qualifications. So that's year 2. Year 3, again, same entries. I recognize my cost, put it in the contract asset, contract liability for whatever the state pays me. So 16.3. And then I bring this 16.5 over here. And I end year 3 with a balance of 35,200 in my contract asset. And my contract liability is 32,250. So if nothing else, at least my assets are growing a little bit faster than my liabilities. So at least I'm not showing really big liabilities and no assets to offset them. So that's really the one benefit we've got here under this new revenue recognition method. In year 4, again, same thing. There's my costs all going into that contract asset. What I'm being paid by the state is going into my contract liability. So I end up with 43,900,000, excuse me, and 45,750. So right here, all of a sudden it switches, and now I'm going to show more liability than assets. Thank goodness we're just about done with the project. Last year, 3,200,000 gives me a balance of 47,100, which is the total cost we've seen in the past. Contract liability, last payment, 42,50. There's that 50 million that they paid us total. And now that I'm done, I can finally recognize revenue and cost of goods sold. So we start with the revenue. I get rid of the contract liability. And that becomes my revenue. Then, because I also have to get rid of my contract asset, that becomes my cost of sales. That's it. All there is to it, to this method. So really straightforward and easy, but again, remember that it's got a really negative consequence for my financial statements, and that's what companies want to avoid. Now, we've talked about a lot of stuff with revenue recognition. The last thing we need to mention are just a couple of slight differences between US GAAP and IFRS, and they really are slight because the two boards put this new method together as a joint project. So really just very small things. First off, IFRS defines probable as being more likely than not. Under US GAAP, it's probable if it's more than likely going to happen. This is simply more likely than not. So with US GAAP, probable is probably around the 75–80% threshold, somewhere in there. For IFRS, more likely than not is 51%. So it gives us a much easier threshold to start recognizing revenue. In addition, IFRS requires companies to disclose disaggregated revenues. So in the footnotes, you have to show what revenue is from traditional sales versus early recognition versus other projects. Under US GAAP, we have a bunch of additional disclosures on how we're coming up with estimates, what methods we're using, some of our calculations. So a lot more has to be disclosed in US GAAP financial statements. Last thing with IFRS is it only applies to publicly traded entities, not for profit. Smaller entities can choose not to use it. They can stick with the old method, which will save them a lot of money because they don't have to switch their computer systems or their methods. They can keep using what they were before. Hopefully you've noticed that even though this method theoretically sounds really simple, as you get into the details, it can get really complex, deciding how much and when and what are the exact obligations, etc. Lots of cool stuff with revenue recognition, lots of neat methods that we've gotten to practice. Hopefully the basic concepts make sense and you're feeling comfortable with all the different methods that we talked about. If not, please shoot me an email or come see me. Let's talk about it a little bit more. That's the end of this discussion. As we move on, we're going to talk next about cost of goods sold and then on to more exciting topics. After that, fun just continues. We'll see you then. Thanks.